Well, hi everyone. Welcome to Buffett and Beyond Research Stock of the Week, and we're going over Meta, everybody's favorite. This is May 31st, 2025, last day of the month, of course. And what's up 150% over the past 2 years? Yes, you guessed it. Meta. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at Meta, and we all know what this stock is and what this company does. And it operates the world's leading social networking service through its Facebook website. And the company's web-based tools allow users to connect and communicate with each other. Of course, we all know that. Has about, get this, 3.27 billion monthly active users as of the end of this past year. Also owns Instagram, WhatsApp, and Messenger, and it generates substantially all revenue from selling advertising placements to marketers, and has over 67,000 full-time employees. And let's take a quick look at how it compares to the average stock out there. Average stocks are in blue, and this is a composite of about 1,800 different stocks, and Meta is in green. And you can see that when we talk about the clean surplus return on equity over here, it's at 23. Meta, and this is the 5-year average, Meta at 23.8%, while the average stock at 13.5%. So the clean surplus ROE indicates that, well, first of all, it's a comparable return on equity and not the traditional accounting return on equity. Totally different. But allows us to compare Meta to Amazon, to Microsoft, and on and on and on, where traditional accounting does not give us that opportunity. And how do we know that? Because everybody that analyzes stocks and runs the publicly traded mutual funds, 96% of them cannot outperform the average stock over any 10-year rolling period. And this is a Morningstar report. And therefore, we have to put stocks that have a higher return on equity, which measures operating efficiency and is comparable, and we want stocks in our portfolio that have a greater than 13.5% return on equity, because we want to outperform the market averages. In over 22 years, we have done that by 2.5 times. So yeah, we're outperforming just about all those money managers out there that are running the publicly traded mutual funds. Now, net income is the clean surplus earnings. So you take traditional accounting earnings, take away all non-recurring items, take away the future liabilities, take away those stock options that you hear about all the time, and you get a comparable net income. So it measures the true core operating efficiency of the company itself, and it is just about twice as high as the average stock out there. And then when it comes to revenue, well, you can't bring money to the bottom line if you're not bringing money in the door to begin with. So the revenue, of course, is before expenses. And then we see how efficiently this company is bringing that revenue down to the bottom line with the net income. So revenue, yeah, about 3 times as much as the average stock out there. So Meta is really chugging along. And let's take a closer look at this company here, and we can see the net income has been rising all these years. Every year, more and more money comes in that door. Exception of 2022. Yeah, that was the year that the market went down, and it was down almost 20%, and the Nasdaq was down 34%. So Meta still brought money in. And of course, you could see that everybody stopped buying things. I shouldn't say that, but they didn't advertise as much because the market was going down. And it just started paying dividends recently, just in this past year, 2024. And it's just paying small dividends because we want to see most of the money go back into the company in order to grow. So we look at the retention rate, and that gives us an indication of whether the company is growing or not. So Meta is taking about 95% of what it makes and putting it back into the company in order to grow. And how do we know that it's using that money efficiently? That's when we look at the clean surplus return on equity. And to get into our growth portfolio, we want to see a clean surplus ROE averaging above 20%. And this stock fully reflects that operating efficiency. Years to pay debt, that's Buffett's rule. He says if a company takes all the money it's making and puts it back into itself in order to pay off its debt, how long would it take? His average is about 5 years or less. Ours is 3 years or less for just about all stocks. And this company can pay off its debt in a few months. So we don't even worry about the debt. Rising interest rates will not hurt this company relative to its operations. Now, higher interest rates may hurt other companies that are advertising, but that's a different story. But this, as a company, we don't worry about the debt at all. Recent dividend, just 0.4%. We like to see a low dividend for growth stocks. Why? Because we want to see it take all the money it's making, or most of the money it's making, and putting it back into itself in order to grow. And how has this stock done in 1 year? Well, with the market, now this is the past 12 months, with the market up about 11%, this stock is up about 35%. Over 5 years, with the market up about 90%, this stock is up about 190%. So yeah, you can see that it's out doubling the S&P 500. And I mentioned the 2 years, it's up 150% over the past 2 years. Well, here's 2 years, each one of these bars. So this is right in here, this is 2025, and this is 2024, this is 2023. And 2022. Remember, I mentioned the market was down in 2022, so you could see the black line, the S&P was down. This stock fell down more because people, the traders out there, were saying that it's not just not going to make any money. Well, folks, it's got 3.7 billion followers, so yeah, it's going to make money. Anyway, they drove the stock down, and then 2 years, a little bit more than 2.5 years ago now, this stock started at the bottom and started to come back, and wow. And we're trying right now, it's trying to gain its previous high in here. And boy, it looks like it's going to do it. It had this little decline in here with the market when the tariffs came out and the market hit the skids, was down 20% in about 3 weeks, 4 weeks, and it came down with the market, and now it's just shooting right back up again as the tariff fears are starting to abate a little bit. So, folks, yeah, we have a good stock here. It's been in our portfolio. I can't remember how long ago we put it in our portfolio, but we saw that advertising ability, and it certainly has come true. So this is a good stock. You put it in your portfolio and you hold it, and if ever it goes down, you add more. And that's exactly how we're handling that. It's been very good to us over the past, 10 years that we've had it in our portfolio. So, folks, we had a fairly good week this week. You go out this weekend, you take your mind off the market because it'll be back open here in a few days. So you go out, take it easy, be with your loved ones, walk on the beach, forget about the market, and we'll see you right back here in a couple of days.